There are two key considerations, two key concerns that everybody has. Number one, does it result in some degree of inflation because a tariff is essentially a price hike in one way, shape, or form? And number two, does it result in some change in economic activity, which most people have been focusing on in terms of a reduction in economic activity? People will buy less, corporations will buy less because it costs more. But there's also this interesting front-running aspect of it in that there has been a little bit of a pickup in activity in anticipation of the implementation of tariffs. So we've actually seen a little bit of an uptick in some of the data in December, January, into February. And then we're starting to see the offset as the data surprise to the downside as tariffs loom as being more imminent, more of a real and present threat. When we think about those implications for the bond market, first and foremost, the fear for much of last year, especially as Trump's re-election became more probable, was inflation. And as mentioned, clearly there's a price hike associated with tariffs. However, most participants are thinking that that's a one-shot deal. The prices get elevated, they get adjusted once, and then they kind of reset at those levels. I think now the market in the last month or two has increasingly started to focus on the growth ramifications and the fact that it probably leads to more uncertainty, less activity, and a downdraft in growth. And that's certainly what we've seen when we come to the capital markets. The consequence, we've actually seen bond yields drop, bond prices rally, which was not, I think, what the market was anticipating a few months ago. Bonds act as a really good offset to equities, and we've seen that directionally more recently where bonds and stocks have started to trade a little bit more in the opposite direction again. So bonds act as a bit of a shock absorber. They insulate investors from the worst impact of a really serious and prolonged trade war. We've been positioned long in duration ever since the early stages of this year, just because we were getting somewhat more concerned about the implications for decelerating growth, which we figured would be good for government bonds. So far, directionally, it has been. The second thing is to dial back our risk exposure a little bit. We do not believe that we're in an environment where the sky is about to fall. We don't think that we're staring at a mega kind of downdraft in the capital markets. But we've had a couple of very good years, probably looking at a more choppy environment this year. So we think it behooves investors to get positioned a little bit more defensively to ride this out, a little bit more in bonds, a little bit less in risk. Still think by the end of the year we're going to be okay, but it's not going to be a straightforward road. It's going to be a rocky one, as we've already seen over the first couple of months of the year.